Hello, good afternoon, everyone. My name is John Geminade, EVP of Production here at Angel Oak Mortgage Solutions, and we're here for our quarterly broadcast. I'd like to welcome Tom Hutchins, President of Angel Oak Mortgage Solutions. Tom, welcome.
Yep, great to be here.
Yeah. So, Tom, we just got off of our annual sales conference here in Atlanta. Just kind of give me a recap of everything you felt and saw and
Yeah. Well, it's always great to get the whole sales team from across the country together and just, share ideas, talk about business, where we've been, where we're headed, those kind of things. But it was awesome. We had a great event. You know, Certainly mixed in a lot of fun with
yeah.
with our business time, our meeting time. So yeah, great event here in Atlanta. Always great to get the team together. But a couple things struck me that I was just thinking, like, what does this mean, or what do we look like today? And I'm just kind of in awe of the experience of our team. We have lots of people, both certainly on the sales side, but in operations and credit and underwriting, that have been with us for so many years. And in fact, we had an awards banquet Monday night,
Mm-hmm.
and we inducted 4 people for the first time ever into the $1 billion producers club. So we have 4 individuals that have closed over $1 billion of non-QM at Angel Oak. So
Yeah.
pretty impressive.
Yeah. And Tom, the thing I took away from it is, how we continue to collaborate and want to make the transaction so much better, not
Yes.
just for the loan officer, for the borrower. And,
Mhm.
and I mean, that was literally the focus of everything that we talked about, right?
Well, I think that's where our experience comes into play,
Mhm.
because we've always focused on the process and the experience for primarily the loan officers, so that they want to keep doing non-QM and bring that next loan to us. So yes, you're right. We spent a lot of time on areas for improvement. Although I'd say we're really good. We're just going to get even better.
Yeah. That was the takeaway I took. And, thank you for your commitment, to Angel Oak's commitment to making us the company we are today and going forward. So let's talk about originations, right? Let's talk about,
The market.
rates, the market. Let's talk about it, Tom.
Yeah.
And what the Fed has talked about last week, and
Mhm.
and originators, what they can look forward to in 2025 and beyond. So give us your take, please.
Well, I think those that have paid attention, it's a higher for longer message. The Fed is not going to be in a hurry to lower rates. We all know that the historic low rates we had a few years back are, won't say never, but highly unlikely to be around anytime soon. So, I think loan officers just have to prepare for that. If
Mhm.
rates stay in this current range, maybe they'll come down a little bit. Maybe they won't. Does every loan officer have a good strategy and a good plan to grow their business in this market? Because we see people growing their business even though the rate environment hasn't really improved.
Yeah. So we talk about, and we're not going to talk about products at the end of the quarterly webinar that we're doing today. I'll talk about our next webinar deep dive and
Yep.
stuff like that, Tom. But, why is it so important for originators to diversify, not just from agency business, but just into the non-QM space?
Well, I'd say probably first and foremost, non-QM is growing. So it's a segment of the market that continues to grow in a market that's shrinking. So if you've got a shrinking market, but there's a subset that's growing, why would you not participate?
Mhm.
And I feel like we've seen a lot of new originators participate in the space in the last couple of years due to the high agency rate environment,
Mhm.
and they're building their businesses and they're becoming experts at. It's really not, it's not a niche product anymore like it used to be viewed. This
Yeah.
is a mainstream core product offering, and a space that every originator across the country should be participating in.
Yeah, I think there was some podcast the other day you and I were talking about how 73 million people.
Hmm.
Yeah, go ahead.
No, well, yeah,
yeah,
no,
yeah.
it's from 2023, 73 million Americans generated 20% of their income from a gig economy, self-employed environment. So that's a big number. You know, we've talked about 20 million full-time self-employed, but think of the additional 50 plus million that do something different. And if you only have agency and traditional tax return type guidelines, you're going to be missing out on a lot of potential loans out there.
You're losing market share.
For sure.
The MBA is saying, agency business is going to grow maybe 20% in 2025. And I think that's aggressive.
Yeah.
I know we put our projections out there and,
Mm-hmm.
We had all the salespeople here and if anyone in non-QM is projecting less than 50%, you're losing market share. But, Tom, you talked about 73 million people, 20% of their income is from Giga. That's supposed to be 76 million in 2024.
Yeah, it's growing.
Yeah.
I mean, there's no doubt. Just look at the world. Things are moving fast. People are starting their own businesses. It's really easy to start your own business today. You can we could do it within the next couple hours if we wanted to. So
you talked about that last quarter.
Okay.
It's like
Well,
it's great because I think it needs reminding, right?
Sure.
You could set up an LLC with I think last quarter you talked about like within a day. You could start a business in the morning and being self-employed by the afternoon. So, and there are 430,000 new business applications every month.
It's amazing.
And that's not slowing down. So if you're really not building on this portion of that segment of the workforce, you're losing ground. So, a couple of other things we want to talk about, we had this great sales conference and, we've got these hard charging, our average AE in our company is over 6 years just at Angel Oak.
Tenure and experience is unbelievable.
Yeah. And we talk about, how do you get in touch with an experienced account executive here at Angel Oak?
Well, hopefully you already are.
Yeah.
But if you're not, it's real simple. We have a website and it's just find your account executive and there's a map and you click on your state and it shows you the account executives covering your market. So super simple. But I think for those that are tuning in today to just kind of learn how to get started in non-QM, that's how you get started. Yeah. Because you bring in an expert who's been originating these loans as an account executive for many years. And they can walk you through the process, because at the end of the day, you as an originator need to think of yourself as an expert, but you don't actually have to be the expert. You just have to have the account executive that actually is the expert.
So Todd, talk about, what our account executives will do on behalf of their originators, right? So
kind of, just expanding on the expertise and we sponsor lunch and learns all the time where an originator grabs their referral partners and has them come and we'll talk about the non-QM products. And it's amazing what a great turnout people get. And we do that and we encourage that because exposure is the way to go. Then after that is social media and getting marketing out there and exposing yourself and marketing yourself as an originator as an expert in this space, and it will draw attention.
Yeah. I think it's 9% of the loans we close actually in one of our programs are bank statements, right? 9% of the loans we close are real estate agents. And so do the math, right? You get 12, 13 real estate agents in a room that our account executive will educate on your behalf. You're going to close probably one of their loans. Yeah. And that's what the experience at Angel Oak will do for you on your behalf. I mean, it's like, I kind of go back, what's your marketing plan for 2025, right? What you as an originator, what's your plan for 2025? Because if it's the same of 2024, you're going to lose market share. And if it's not incorporating non-QM into your space, you're losing market share. So I'm sorry.
Well, and I think just adding on just with the market, with the higher for longer, home equity, HELOCs, those are a big product for us and they're growing rapidly. So I think originators really need to tap into that market, because if rates stay where they are, which they're projected to for the remainder of 2025, there's still people that need to tap into their equity. I mean, what did we always say? It's record credit card debt right
It's
now.
over $1 trillion.
Yeah, and it's average 25% interest rate. So those are products and programs that are well played in the non-QM space.
Yeah, I mean, and since 2019, home appreciation has been over 54%, right? Depending upon your market, it's probably even more. So, as higher for longer, as Thomas said, and one of our account executives on the West Coast, he talks about everyone's in generational rates right now. Like, we will not see these for generations, and there are generational type equity in your homes. So why not create your own business plan of HELOCs, close-end seconds, tap that equity, and it's create your own business plan, and let us help you do that. Yeah.
I think also, just changing gears on you a little bit, but we talk about the rate environment, the economic, just kind of the future of mortgage. I've been getting asked a lot about the new administration. They're a few weeks in, lots of changes, lots of chatter, some good, some bad, as far as its impact on housing and the mortgage space. But I think the CFPB, everybody in the mortgage industry has heard about that and what that's going to mean. But I've been asked, does that mean everybody's going to change how they do business? And I just don't think so. I think we've had some actual good improvements to our business and to our industry, like appraiser independence and things like that. So it's all good. But I am pretty confident that the current administration is focused on real estate, focused on housing, which ultimately is going to help us.
Yeah.
So a lot of chatter about tariffs and driving up cost. But at the same time, if we can drive down the cost of regulations, maybe there's a happy balance. And I don't think we're going to see the impacts of that for a while. But it's interesting to hear about it on a regular basis,
on a daily basis.
Yeah.
I mean, yeah. So it's we're just starting 2025. You've talked about rates higher for longer, but a lot of the, I won't even say chatter, a lot of the enthusiasm over the last 48, 72 hours that we've had here at Angel Oak with our conference and everything. I mean, talk about tailwinds. I mean, just.
Yeah, well, we saw, what was it, probably October of 24, just a few months back, rates tweaked down a little bit, and everyone in our industry felt the tailwinds. Now, rates have since gone back to where they were previously. I would call them headwinds at this point. But even during this cycle that we're in right now at this stage, there's tailwinds around non-QM. And that's what I think you even said, most people, we are forecasting a 50% growth rate over last year and think it's extremely attainable based on current run rates and things like that. So there's not a tailwind in economic tailwind in housing and in the finance industry, but there is tailwind behind non-QM because there's just so many underserved borrowers. And as we've seen over the last couple of years, a lot of originators, maybe for the first time, originated a non-QM loan. And that's what I kind of think it just reiterates the need for people to expand their product offerings into non-QM.
Yeah, if you're not diversified in your product offering, you're going to lose market share. I don't want to be a naysayer, but I hate to, if you're out there originating loans, we talk about it all the time. It's an underserved borrower, and that underserved market is continuing to grow. So it behooves you to really diversify your program offering, diversify your knowledge, and let Angel Oak help you.
And you can't not say that most originators are always looking to differentiate themselves. So how are you differentiating yourself? Non-QM is a obvious way to do that. So take advantage of the opportunity.
Yeah. So Tom, before we kind of wrap up here, we'll be back here next quarter, obviously talking about the just the economy, the non-QM space, and we just got off a great conference. just talk about what you're looking forward to, in the next couple months. Just
Well, everybody likes to get finished with January and February as quick as possible, right?
Right.
We can't kid ourselves that those aren't the greatest months of the year generally. So, the spring buying season, I believe there's still a lot of activity that's going to happen in the real estate industry. Just people have been, yes, we talk about locked in to these low rates, but people, we're very transient market economy, transient people. I think we're going to see a lot more activity this spring and summer buying season. So always excited about that time of year.
Yeah. And, as we wrap up here, we will be doing we're not talking about products really today, but we will be doing a deep dive into that debt service coverage ratio program. And, we're still seeing that program, it's become the number one program.
It's growing.
Maybe talk a little bit about why that is.
Yeah, it's just, investors see opportunities still in the market. And whether it's first-time investors or professional investors who have a big portfolio, the DSCR loan is great for any investor. And yes, we've seen a lot of growth around that. And then, not to talk about products, but bank statement for the self-employed borrower. Those are the two mainstays of non-QM, and we're seeing growth among both. But if you're not participating in either of those, keep it simple. You can just bank statements for the self-employed, and then the DSCR for self-employed investors.
Yeah. So February 27th, noon Central Standard Time, we'll be doing a deep dive into debt service coverage ratio with a couple subject matter experts. And the other thing I wanted to talk about.
One thing that I was also excited about is we're just now rolling out some big enhancements to our products. So stay tuned. Not going to cover it today, but certainly you'll see something from your account executive, or find that account executive you don't have, and they'll take you through the enhancements. But it's just opening the bucket up more where it makes sense. We've been doing this for over 12 years, so we have a really good grasp on what is needed in the market, and we see it shifting. And when there are shifts, a lot of times we'll make exceptions on loans, but when we see we actually like those exceptions, we just change the guidelines and expand the product. And we just had some big ones come out this week.
Yeah. So, I mean, again, we're talking about easier, faster ways to close loans here at Angel Oak, right? So, so Tom, thank you for joining me today. Yep. I really appreciate it. Thanks for your leadership. And again, John Jimenad, EVP of Production. Reach out to your account executive, because those enhancements Tom just kind of glossed over a little bit will actually help you save deals and close more loans. So on behalf of everyone here at Angel Oak, thank you for attending today. We really appreciate you and look forward to seeing you next quarter. Thank you very much.
Thanks a lot.